Good afternoon, everyone. Welcome back. This is US Home Talk here. We are live every Wednesday at noon and on demand at ushometalk.com and everywhere else that you find your podcasts. So we are your hosts. I'm Mike Overson, Illuminate Home Loans. I have Jason Walgrave with Walgrave Real Estate Group and the Minnesota Real Estate Team at RE/MAX Advantage Plus with us, as well as Marcus Walgrave with Hegg Realtors. We're going to be taking all of your questions during our show today. So anything and everything dealing with real estate, we will answer those questions during our show. So you can call in with your questions to our call-in number. That number is 612-234-7585. Again, 612-234-7585. Or you can go into the comments section on Facebook and you can type in your question there, and we'll answer that question live during our show as well. So we will also be answering any questions that came in during the week. So that phone number that I gave out is actually our 24-hour real estate hotline number. Again, it's 612-234-7585. Any questions and calls that came in during the week, we're going to answer those here as well. So we like this to be an interactive show. Definitely reach out to us through that phone number, or like I said, you can go to the comments section on Facebook and submit your questions and stuff there. Fellas, how we doing?
How's it going, Mike?
Yeah, I love it. Let's go.
Marcus, you've been working on your
channel. Fantastic today. We had a
Go ahead.
I was gonna say, Marcus, you've been working on your tan a little bit there.
No, not too much. I try to stay out of the sun as much as I can. Jason can contest to that.
I kind of expected you to be a little bit more burned up here, to be honest with you.
I had a nice golf sun hat on that I rocked this weekend, and some long sleeve gear. So
because you've been outside at probably track stuff quite a bit lately, right?
You were rocking
track events.
Yeah.
Well, I'm a board member on the Dakota Relays. It's one of the Midwest's premier high school track meets. And we worked that a couple weeks ago, but like I said, I try to cover up, so I may be outside quite a bit, but I kind of avoid the suntan as much as possible, as you can see.
Marcus and his amazing wife Caitlin and girls came up this weekend, so we got to spend some time with them. It was a lot of fun. So I like the shade as well. I mean, I like warm places, beaches and water and all that good stuff, but I'm much happier if I'm in the shade.
Shade with a breeze.
And we know Overson, we know you like to tan. Gentle breeze.
Oh, yeah.
We know Overson likes to tan out on his beach. Usually in his Borat mankini is where we find him and what he wears, which is your neighbors always appreciate.
It's either Borat mankini or my American flag Speedos, one of the two. But just get out there. Maybe put some sunscreen, like a 5, maybe like a 5 or a 10 SPF. Get out there.
Tell you what, we put the whatever it is, SPF 1000 on the children, and the next morning after swimming in the lake and showers, they still had a nice layer that was on their face. So I think they were safe.
They were well protected. Yes.
So
all right, Overson, what's the big topic?
So what we're talking about today, we're going to talk about this debt ceiling stuff, right? We're going to talk about that. We're going to talk about how that impacts interest rates, and we're also going to talk about how that impacts home prices. Because, and then we've spoken about this before, and I don't want to beat a dead horse, but it's almost like we have to beat a dead horse, to be honest with you. We have the media saying one thing, but in reality, there's something else happening. Okay, so let's talk about the debt ceiling stuff and interest rates. So the debt ceiling, if you go back 2 weeks ago when we were talking about all the debt ceiling talks there, that's obviously something that affects our government, right? Our government was potentially going into default. They had to raise either the debt ceiling or figure out some sort of solution there. Well, our government also backs 70% of the mortgages that are in this country. So Fannie Mae and Freddie Mac insure 70% of the mortgages out there. So if our government then defaults, right, or has some sort of economic failure there, that's going to affect mortgage interest rates because they back 70% of the mortgages that are in the country. Okay. So what did we see happen over the last 2 weeks when all the debt ceiling stuff really hit the media and was put into light? Well, we saw interest rates go up a full percent in 2 weeks. You know, we were sitting in the low sixes and we went all the way up to the low sevens in 2 weeks. Okay. So now if we look at the charts, now that a kind of like a quasi deal has been reached, right? And it's been like a verbal deal. Now they just got to finalize a couple things and get it inked. I mean, we've seen an immediate rebound this week of where mortgage rates have now come down about 0.25% over the last 2 days, just because there was verbal talks of an agreement being reached. So it's crazy how quickly things can swing. And my point with all this is that even though things look like they're heading in the right direction, it's not a straight line in the right direction. We're going to take 3 steps forward and we might take 2 steps back. We might take another 3 steps forward. We might then take 4 steps back, you know, and then another 3 steps forward, 1 step back. So it's not going to be a straight line for the better. And we all have to realize that. And as long as we're comfortable with that, we know the general trend as far as interest rates go are going to be declining from now to the end of the year. But again, like I said, it's not going to be a straight line.
Nope. And it's not going to be a quick straight line either. So,
right.
You look at some of the forecasting too that was done earlier in the year, or even at the end of last year, whether it was the National Association of Realtors that has, you know, incredible amount of data collection, or even Freddie Mae and Fannie Mac. I mean, none of those entities were saying, hey, we were going to be, you know, mid sevens by the end of May. So it's interesting just to see kind of how that, you know, a lot of them were saying, you know, we might be like mid fives, high fives by the end of the year. So, you know, to your point, you know, Mike, you know, we may not steadily go to that, you know, forecasted rate that was, you know, forecasted 6-7 months ago. You know, but that's kind of what everybody was forecasting earlier in the year, was that at the end of the year, they were going to come down. But I mean, you've always said it, you know, every week on the show about how political events, world events, even weather events, you know, they can create that, in a sense, emotional reaction. And if you don't have an expert, you know, helping you guide through, is this a time to lock in a rate, or is this a time to buy? You know, you definitely kind of feel lost and discouraged, you know, especially with how the news articles have been here in the last couple of days, or previous days, I should say, you know, over the weekend and last week, Thursday, Friday, especially.
Yeah. Yeah. And the other thing that comes along with this too, then, is, you know, the thought or the notion of, well, as rates go up, home prices are going to come down. Or, you know, if this continues to last, you know, home prices have to come down. I don't know how many times I've heard that, right? We're going to wait because home prices have to come down from this.
Yeah.
The problem is they're not. Report came out just yesterday from Case-Shiller, like the number one, you know, home price index throughout the entire country that compares year over year numbers. We're up 0.2% from last year in home prices. So everything that we have been seeing so far has not suggested that home prices are going to go down. They've actually continued to go up. And if we look forward, moving forward here through the rest of this year into maybe next year at this time, everyone's pretty much predicting that they're going to continue to rise because our inventory levels are so low. So the other thing to know and learn here is that, you know, there's some people on the fence because we're going to wait for a particular interest rate to come around. Mistake number one, right? Number two is some people are like, home prices are going to drop. We're going to wait for the bottom of the market to happen, and then we're going to buy. That's also going to be a mistake, you know? So everyone in the industry, and if you look at spring numbers last year to spring numbers this year, when rates hit 7.5% in October, and they hit sevens again in March of this year, and they hit sevens again just last week, right? Through all of that, home prices haven't come down. They've continued to go up. So what makes you think that they're going to come down in the future here? as rates are predicted to come down,
Right.
then home prices, that would just make sense that home prices would just elevate even more. So my whole point on this is, waiting is going to cost you more. I really truly believe that. Home price wise, waiting is going to cost you more. If you have the ability to buy now, definitely buy now. You can always grab a lower interest rate in the future through a refinance whenever rates get to a certain spot where it makes sense for you to do so.
Yep. I agree 100%. And it's, I was just having this conversation with clients a couple of days ago, because they were talking about prices, and their belief was that the prices are so high because of COVID, that it was all COVID driven. And they said, well, that's actually not the reason why the home prices are up. It's because the inventory is low. And the reason the inventory is low is because for an entire decade, there was 80% less homes built in the United States. So you go back to the crash of 07, 08, and then you look at between 2010 and 2020, the crash, it put a lot of builders out of business, and developers and mortgage companies. I think it was like 74% of all mortgage companies went under. So then you look at that decade between 2010 and 2020, and if you go back 5 decades previous, so you go back 50 years, 5 decades, there were 80% less homes built in the United States for a 10-year period. And so, we're 2023, so we're only 3 years out of that decade where that many less homes were built. It's going to take a long time to recover that inventory, and so that's the biggest reason. There certainly are, folks out there that, there's this domino effect where, well, there's low inventory, so I can't find a place to go, so I'm just going to stay where I'm at. And so there's a few other factors that play in as well. But that's the main reason why the inventory is so low. So with low inventory, creates high demand, multiple offers, drives up the price, so on and so forth. So, but, the interest rate stuff, again, we haven't really had concerns this entire year from the majority of our buyers. We've got, they're just talking about the interest rates. People still need a place to live. They want to buy a home. It means they can't buy as expensive a home this year as they could last year, but that's okay. They still see the value in home ownership, the long-term benefits of owning real estate. And so it's still a great time to buy, even though the interest rates aren't as low as they were. It's still better to own and buy in almost all cases than it is to rent. So I think there's some great opportunity out there. We love working with home buyers and with a lot of them.
So here's what I pulled out, and then I know this is not, Ivan's going to roll his eyes when I do this, of course, but that homes built by decade. So here's the chart, as you can see there, right?
There you go.
So this is in millions. I mean, so you can see way over here, right? So that's 2010 to 2019. That's 2000 to 2010. And then it keeps on going back, right? Look how many, only 5.8 million homes in 2010 to 2019 were built. In the previous decade, there was 27 million. 27 million homes from 2000 to 2010. And then 2010 to 2020, there's only 5.8 million homes built.
Yeah, it's, and how many people are in the United States? 380 million, or what's the current population? Something like that. Evan probably knows. He's our stat guy.
Well, how many Walgreens
Not a lot
are
of
there?
homes.
That's the question.
3.4 million.
Walgreens
Not million.
Not enough.
We're all related.
Trying to catch up to like the Johnsons or,
Yeah, right?
The Smiths.
Smiths and Johnsons.
Yeah. You kind of look at some of the inventory talk as well. And, and we're talking about building construction, right? And so if you are a buyer out there, instead of, falling victim of the clickbait, articles that you may come across online, the gloom and doom, really grabs your attention and has you dive in there. And then in maybe the last sentence, they might say, or maybe not, but I mean, if you look at like your local builder and see how they're doing, right? Our local builders are doing very well. They have a lot of individuals that are looking to, build custom homes, and they're putting spec homes out there too. And their spec homes are not sitting on the market very long. we talk about the increase of home value. New construction is a good driver for that as well. Every time that a builder builds a floor plan that he built last year, and that home by default, because of material and labor has increased, say 5%, it's like, well, there's a really good sold comp for your house that's only 1 year old. Your builder just built it, and he built it for 5% more, and he sold it for 5% more 12 months later. That's a really good comp, and that helps drive pre-existing home values up as well. So if you're that individual who's like, I'm going to wait for the value of home prices to go down, sure, there might be a handful of markets out there that does happen. But I'd say the majority of the markets are not going to be like that, especially here in Sioux Falls, South Dakota, and the Twin Cities market as well.
So it looks like we got a couple of Facebook comments coming in here.
Definitely. We got a couple
from Tabby. So we built 2 sheds in the garage around 2010. They said the Amish build here, and they're busy. So yeah, so there's definitely building and going on. But the pace of building is still down. I'm very curious to see the pace of building here over the first couple of years, 2020, 2021, and 2022, those 3 years. How do those 3 years, the pace of those 3 years, if we project that out 10 years, where are we going to be at for homes built? Are we going to be lower than last decade, do you think? Are we going to be down to 5.8 million? Or do you think if we take the pace we're on now for new construction, extend that out 10 years, you think we're higher?
Well, I think we're higher. I mean, I think that, I think this decade that we're in, I don't know, maybe we're at 10 to 12 million. There's no way we're going to be over 20 million homes built. There isn't. We can see, there's activity, but there's not that much activity. There certainly was a lot more activity from 2000 to 2010. Holy moly. There was, the Nationals alone were just, man, they were building a lot of homes. So I think it'll definitely be a lot more. I'm guessing 10 to 20 or 10 to 12 million is what'll, at the end of the decade.
Like that chart, was that all homes, or was it single family homes specifically?
It just says homes built,
like multifamilies too.
It just says homes built in the United States by decade.
Yeah, I would bet it's townhomes and single family. So
I would imagine all residential outside of apartment buildings, right? So that would be a commercial deal, but homes, I would imagine 4plexes on down,
Yep.
Let me see that chart one more time. I'm curious about this.
Oh, here we go.
I love this high tech stuff.
It's super high tech here. So you got to go all the way back to like 1940 to 1950 when you're to hit under 10 million built for the decade. So that's all the way over here, right? 1940 to 1950, 9.6 million. And then started in 1950, we were above 20 million all the way up until 2010. Then 2010 to 2019 down to 5.8.
Yeah.
So go back to the 1940s. That's wartime, right? So that's probably the reason for that.
Well, and also, Jason, you brought up the U.S. population. I did a quick Google search. I think we're at like almost like 3.4. If we go back to the 1940s, the population was or it's not 3.4, but 340 million.
Okay.
In the 1940s, we were 130. So if you put it in perspective to the population, they were doing significantly more in terms of a percentage than what we are now today. You look at it. So that's not. It's interesting to see, but it's not really comparing apples to apples when you look at that the U.S. population is now almost 2.75 times larger than what it was in the 1940s.
Right.
It's true. It's always remember to adjust things per capita that way.
Yeah.
So per capita, so basically we almost have 3 times as many people now, which means that we'd have to be at about 30 million homes for this decade to match the pace of homes that were being built back in 1940 to 1950. And we ain't going to get anywhere close to that. We'll probably hit 10 million homes this decade, roughly, I would guess. So inventories the main driver of real estate values. Over my 20 years of being in the business, inventory is the biggest driver, right? I don't know how you guys feel, but it's inventory is going to make up 60, 70, 80% of a home value.
Yep.
Then you're going to have sprinklings of other stuff. Yeah, interest rates might, raise them a little bit up or down, might affect them a little bit. And, economic stuff might do a little bit here, but the bulk of your home value is going to be inventory. And with our current inventory of how low it is right now, I don't see home prices coming down anytime soon.
And there isn't a solution to increasing the inventory in terms of like the new construction perspective. And there's a lot of the chatter about the pre-existing sector of our inventory, and we're kind of in these positions where you do have individuals, maybe the certain demographics who are financially sound, and they look at it and they say, well, gal, we want a new house, but we might just keep our other house and because we only got a couple $100,000 left on the mortgage, and we refinanced it into a 3%. So, I mean, to think that the inventory problem can be solved, in a matter of a handful of years is it's not a very fair thought process. I mean, it's going to take a long time.
Yeah.
Yeah. We need first time. We need entry level housing is what we need. The problem is no builder is going to build entry level right now because there's no money in it, right? And the cost of building is just, even if you built a quote unquote entry level house, what's the cost of an entry level new construction house?
It's $450,
right?
Maybe $4. Go up far enough, maybe $4.
Just the cost, because the cost to build.
$325 down here.
Yeah.
$325. You think, Marcus, down there?
Yep, 320. There's some 325s. Maybe a 2-bedroom, 2-bath ranch. I know you guys call them ramblers up there. With an unfinished basement. Some of our builders have been excluding sod, sprinkler, landscaping, edging. They'll just do what's required by the city ordinance, and that's topsoil grading. To help keep that cost down. But yeah, I mean, there's some out there for 325.
Some.
Yeah, some very, very. I mean, it's and the builders are able to a lot of sell them in house, and when they do go to the market, there's demand for it, and so.
Yeah, the problem is that
what is a property like that rent out for, Marcus?
I'm sorry.
I think he said, "What does a property like that rent for down there? Like how much?"
Oh, what is a property?
I think he's saying, what's it rent for? So how much would you pay in rent if you're gonna rent that house to live in it?
Yeah, if you just did like a general description of rentals here in Sioux Falls, a two-bedroom rental is going to get you about $950 a month. So it's right around like that $450 plus per bedroom is kind of a general rule of thumb.
That seems very reasonable to me. So you're telling me a $325,000 house down there, you can only get $950 in rent on it?
Well, no. If you looked at the entire rental market that we have down here, so okay. including everything, so just the average, But I mean, if you had a brand new, new construction and it was a 2-bedroom, 2-bath, you're probably right around that 1,800 to 2,000.
Okay, that makes more sense.
Yeah,
that makes more sense. But with inventory, so I'm thinking in my head, okay, what fixes this problem, right? It's kind of a problem. I don't know if you could consider it a problem. I don't know if the government considers it a problem, but if we want more of a balanced market, right, we got to have a more balanced amount of equal buyers and sellers, right? That's a balanced market right now. Very few sellers out there, lots of buyers. That's why it's a little bit unbalanced. Sellers kind of have the upper hand right now because of the low inventory. They know they're going to get multiple offers on pretty much anything you put on the market, and then people start, outbidding each other for it. So what's going to break us out of that? What's going to get us more balanced? We obviously don't need more buyers, right? Because we got multiple offers on every single house out there. We need more sellers. So, is there something that can be done? Can the government somehow incentivize sellers, people to sell their house? We need move up buyers. Hey, if you bought your first home 2, 3, 4, 5, 6 years ago, we want you to move up. We want you to move up because we need your first time home buyer price point house to get on the market. That's what's going to help here.
Yeah.
So how do we push that? How do we spark that part of it? Because new construction is not going to be built at the first time home buyer price. Right now, with land costs, construction costs, materials, it's just not going to happen. So the people that bought their first homes 2 to 6 years ago, we need all those people to be move up buyers and get their homes on the market. So first time home buyers come in, and then that gets those people that are selling that house into the next bracket up top.
Yeah. Remember the $8,000 tax credit?
Right.
How many homes we sold during that time? That was such a great incentive. And so I like your idea, Mike. Come up with some type of a seller incentive,
right? Or builders. If you can build, right? If you start building homes in a first time home buyer type of price point, right? Mm-hmm. Then you get this types of tax break or something like that.
Yeah, like tax credits or something for the builder.
Something, you know what I mean? Because it's like no builders want to go there because there's no money in it. But now, okay, so if we get a little bit of bump from the government on either we're going to pay less in taxes or we're going to get some sort of rebate from them or something like that. I don't know. It's just an idea.
I don't mean to brag, but it is something that our state in South Dakota has been doing. We've had this first time homebuyer South Dakota housing loan product that's been available, but they also extended to a move up buyer. So it wasn't just for first time homebuyers. You could still, if you were a move up buyer, you could take advantage of this South Dakota housing loan product that was available to help with down closing costs. And also, our state just passed recently a $200 million infrastructure bill to help developers reduce their costs for developments. So then, with the idea that developer builder, they can get these developments done for less, and a third of their projects can be funded through this new bill that passed, this $200 million bill that passed here recently. So, certain states are doing the best they can to help with that, and they are coming up with those kind of ideas, like you're saying, Mike.
Yep.
But it's not just across the board. I think that's something that you just need to kind of keep in mind as a buyer who might be looking to relocate.
Yep. Minnesota has the same thing too. So Minnesota has a program. You don't have to be a first-time home buyer. You can be a move-up buyer. You can be a second, third, fourth-time buyer. That's completely fine. They typically have income limits on them, so you got to be underneath a certain income limit.
Yep.
And that income limit is based on your household size. So a husband and wife combo is a 2-person household. A husband and wife and 2 kids is a 4-person household. Well, that 4-person household can make more money and still qualify for those programs than like a 2-person household. But yeah, again, and that's on the buyer side of things. I like the development thing, the developer stuff, because again, it's getting cheaper housing, right? How do we make housing cheaper? How do we make it more affordable? Because the more affordable it is, then we get more home ownership, right? More homeowners.
Yeah.
All the stats show that you have safer communities, and you have more community type of programs, and you got this and that going on. So, yeah, it's just been something that I've been throwing around in my head. I'm just like, we don't need to incentivize buyers. We don't need more buyer programs. We need more sellers. How can we create more sellers?
Yeah, it'd be interesting to see if there could be some sort of, like you were saying, a program for pre-existing sellers, not just this, like an infrastructure bill like we have in South Dakota that's helping, the developers, get that done at in a sense a discount, and hopefully that'll translate to more affordable lots. And then obviously if it's a more affordable lot, then you have a more affordable build for the builder, and that can get handed down to the buyer down the road. But it'd be interesting to see what could come up with that pre-existing seller. It'd be nice if they could just say one time where if you were a pre-existing seller, you could sell, and then you could transfer that rate that you have into your purchase. That I think that would spark a lot of sellers if they knew they could keep the rate that they had with their purchase. They probably would jump in the pool.
Yeah. and that's the argument on the other side is, you'll create more sellers as soon as rates go down, because then those sellers, it's easier for them to move up to the next level because they it's more affordable and they qualify. It's tough for someone who's in a $400,000 house now or $350,000 house now at a 3% interest rate to move up to a $500,000 house at a 6.5% interest rate. Right? It's just tough to stomach. Yep. So, if rates can come down and that move is easier to stomach numbers wise, payment wise, then you'll get more people selling. So there's different ways to skin the cat, and this is just all discussion here, and I don't have the answer either. It's just one of those things. I'm like, we need to create more sellers. That's what we need to try to figure out. So what can be done to create more sellers? So,
yeah. And it's going to have to come from the pre-existing side of it. I mean, the builders and the developers are doing, the best they can, and they're building, as fast as they can to make sure that, but still making sure that the quality is exceptional. Because just like you said, Mike, I mean, a community that has high quality homes, that's going to reflect, throughout the community, whether it's parks and programs, crime, income, education, so the value of building a high quality home is second to none. And our builders know that, and they do a very good job, here in the Midwest.
So Evan, I'm curious to get your thoughts, on the insurance side. So we talk about interest rates and home prices stuff going up. I mean, insurance wise, what are you seeing on your end as far as increases, decreases, hurdles? Oh, can't hear you. I think you're muted.
Wow, it's not like I do this professionally or anything. Yeah, increases across the board as you would expect. I mean, it's not just inflationary pressure. There's other stuff going on. There's some feedback loops in the insurance market right now that probably have to be solved. Like, for instance, I don't know if you guys know this, but my car was totaled 3 weeks ago.
Sorry to hear that.
Yeah. It wasn't a big deal. Someone backed into me at McDonald's and just happened to do enough damage that the car got totaled out. The guy that hit me, uninsured. He had insurance at one point, but clearly couldn't afford to keep paying it, because I've been seeing more and more quotes that are just like, no one could afford this. I had a guy call me for insurance about 2 weeks ago. This quote was $560 for just him a month.
Oh,
yeah, exactly. The sort of rates that you'd be expecting to pay as a family. You know what I mean? Like 3-4 cars, that kind of thing. That was just him in one car. And his driving record wasn't spotless, but it wasn't like, oh yeah, you've got like 5 claims or anything like that. And I'm seeing more and more of that kind of thing. So you add those two factors together, and you have a rapidly increasing price spectrum for the people who actually have insurance. And then you have more and more people no longer able to afford insurance, driving up costs for people like me who have insurance, right? So my insurance company's paying the thousands and thousands of dollars for me to get the new car, and they don't have anyone to go after. They don't have any policy on the other end, so they have to raise my prices in accordance with that. So we're seeing lots of that in the auto market, and on the home market, we're seeing other feedback loops. I don't know if you guys saw this in the news, but State Farm in California announced at about 3 p.m. on Friday, they said, as of midnight tonight, we're no longer writing new home business in the state. We're done. We're done until something changes.
In the state of California.
The whole state of California. Biggest insurance market in the country. Biggest insurer in the state. Biggest insurer in the country, right? State Farm is the biggest personal lines insurer, and by far the biggest in California. And they're just like, yeah, we're not going to write any new policies. They will continue to service existing policies. They're not fully pulling out of the market, but they're just like, we can't underwrite these risks, and the state won't let us set rates appropriately for the amount of risk, wildfire risk, and the pace of rebuild costs has outstripped hugely the pace of premium increases. You know, imagine if you looked at your expenses as a business and go, yeah, okay, so year over year we experienced about 20% increased costs. And this is a random number I'm picking out of thin air, but it's something in that space, right? You go, yeah, insurance, we paid out 20% more this year than last year. So you go to the state and you say, hey, so we need to raise rates an aggregate total of about 20% because we've been paying out 20% more. And the state goes, that sounds kind of expensive. How about we only let you raise rates an aggregate of 3%? And we've been seeing that not just in California, across the United States. A lot of states have been trying to control insurance pricing by just not allowing companies to raise rates. So we've seen companies pull out of now California, but also pulling out of Florida, pulling out of Louisiana, pulling out of a number of states where it's just like, oh yeah, sorry, you can't raise your prices that much. And the company just goes, okay, we just won't write new policies. We're done. So yeah, a lot of stuff's going on.
It wasn't just State Farm too. I mean, they were, I think.
No, they're just the most recent.
Yeah, they were the most recent. Like prior to State Farm, the number 2 and number 3 in the state had pulled out, earlier in the month or whatever it was recently too. So it wasn't just like they were the first.
I routinely write with 8 standard carriers, right? Carriers that people have heard of or maybe have heard of, right? I write with Progressive, I write with Safeco, Nationwide, all that stuff. Of the 8 carriers that I work with, that I write a lot of policies with, only one is still writing in California. I have a buddy of mine who just bought a condo on Friday, and it's like between the time that he was like, hey, closing's in 3 weeks, can you get me some quotes? I wasn't able to bind a policy that far in advance, and in the time between that quote and the policy, sorry, that company no longer writes new policies, so we had to scramble to find him a different one. Luckily, since it's a condo, his master policy is good enough for closing. Sweet. Like underwriting on the loan is happy, but we still have to insure your stuff. So yeah, it's wild. California and Florida are the 2 most notorious for this, but Texas has been experiencing a lot of this. Louisiana, Arkansas, I think I saw a whole bunch of the Southeast states really, where it's, like they're not able to properly underwrite hurricane risks and wildfire risks and stuff like that. And the states are going, yeah, but if you raise your prices 20% a year for 4 years, no one's going to be able to afford insurance. And the insurance companies are going, yeah, we know, but that's how much it's going to cost. We need to do something.
But
and nobody wants
to continue to pay this money out and not get it in.
Right.
So
it's a double-edged thing that just we have this kind of runaway feedback loop in insurance markets. And as far as I can tell, the only real solution is like state subsidy of insurance because it's like unaffordable.
That was going to be my next question, Evan. I mean,
let me tell you, Marcus, I'm sure you're asking a great question, but it's coming through as just garbled nothingness. You're frozen.
Oh,
yep.
The Walgrave curse has struck you now.
Yeah, that's
Jason, okay, you're back. Let's try that one more time. What's your question, Marcus?
My question is the insurance industry similar to the home mortgage industry where 70% is backed by the government, or does it have a different type of structure?
It's structured very differently. So the insurance market is a much more private market. There are reinsurers, which are basically like insurance companies for insurance companies. So you buy your personal policy in the same way that like when you get a loan from Mike from Luminate, that loan will enter into the space of loan trading, right? Your loan might be serviced a year later by U.S. Bank or whoever buys that loan on the secondary market. Insurance kind of works in a similar manner in the sense that you have a policy with Travelers or State Farm or Safeco or whatever, right? And you and that company always have that relationship, but then the company that you're with, if it's Travelers, they're selling risk from their block. They say, hey, we have 100,000 homes insured in this state, and in case something big enough happens that we have to go into our cash reserves, we want to be able to spread out that risk to other carriers. So they're basically like super insurance companies that, like in some of them people have heard of, like Lloyd's of London and so on, that basically buy up secondary risk on these markets, and they're protecting it on the back end. But it's that insurance that dictates if something can be written. And so when it comes to Florida is the most notorious one, those super insurers, the things that are above what you are actually buying from, have been threatening for years to pull out of the state. And Florida has been, my understanding, is subsidizing the underwriting there and saying, hey, we're gonna guarantee some amount of this to keep you guys in the state. But still, it's just the risk profile for widespread losses is getting to the point that one of two things has to happen. Either more money has to go into that system from somewhere, or we just don't write insurance in that area anymore at this level. And so that's like the constant game of chicken that Florida's been in for years, and California looks like they're headed towards as well. And in some states, regulators have taken the idea that it would be like if the government of Minnesota just said, we're capping how much you can sell your house for to an inflation rate of 2%. You cannot, you bought your house 4 years ago. You can't do more than 2% plus 2% plus 2% when you go to sell your house. It's a very artificial cap on the price of the home. And it makes the house more affordable, but it also warps the market, because if you do that for, say, a decade, then yeah, the housing prices will be lower, but then you buy the house and your insurance cost is like, why does the insurance company say it would, I bought my house for $200,000 and the insurance company is saying it would cost $600,000 to rebuild? And that's because there's like artificial limits. You're seeing the same thing in reverse in the insurance market in these states.
Interesting. That's super interesting.
So I want to buy a house in California, right?
Okay.
Let's say, oh, dude,
I
want to go buy a house in California. So how do I get insurance? Right
now I have Nationwide as an option, and they have additional underwriting requirements, but they are still writing in the state. And there are a couple other companies that are in that same category where they're saying we are still taking on certain risks, but it's limited. But most of the big carriers are just like, you call them up and they go, yeah, we don't do that. We don't do new home policies. If you want to buy an auto policy, that's easy. Relatively. It's still California. It's still an auto policy, that kind of stuff. But it is not the same sort of mass. It's not an exodus, but like mass shutdown of new policies. It's very scary in the sense that, if you're in the middle of trying to, I'm looking for my first house and I live in California, right? And boy, there are a lot of people that live in California. It's just getting more and more difficult to make that process happen for not just insurance reasons, but a multitude.
So there's no cap on what your initial policy is going to cost in the house. What California is trying to cap is you're starting here. Let's say let's just, for easy numbers, your premium is $2,000 a year, right? We're not going to let you raise that more than $2,100 the next year to $2,200 the next year.
Okay, right? No. So I understand what you're saying. No, the key thing with insurance isn't based off of you. It's based off of what risk pool you're in, right? So I am a man that lives in my zip code. I am single. I am my age. I have, I have this credit score. I have experienced this number of losses in the last 6 years. These at fault losses on auto, these not at fault. Those sorts of things are what your rating profile is. And so the insurance company isn't allowed to just look at me and be like, yeah, but I like Evan, so I'm going to give him a 10% discount. That is against the law in all 50 states across the country. However, if they said, listen, males that live in Minneapolis that are between the age of 35 and 40 have experienced an astronomical increase in the amount of claims that they've made in the last 2 years, right? We predicted 8 claims per 100 clients, and there have been 18 claims per 100 clients. So we need to adjust the rates accordingly for that pool.
Okay.
And so they come back and they say, hey, we need to increase costs by, let's just use that 20% number. 20% number for these risk categories, right? Maybe it's the males between 35 and 40, or maybe it's this zip code or whatever. It's the thing that's the commonality in increase. This is what actuaries do. And so they go to the state regulator and they say, hey, here's the data we have. Here's what we're seeing. And the state can either approve those changes and say, yep, makes sense. There's way more uninsured drivers in the Twin Cities these days. Sure, you can increase rates to compensate for the fact that there are all these, these claims and whatever. Or the state insurer regulator can just go, no, we do not approve that change. It would have too disparate an impact, or you haven't proved out the data for long enough. And so, it may be like a 1 or a 2 year blip, that kind of thing. And so some states have kind of taken that stance for a while, that it would have too large an impact on certain groups' premiums, or that they're, like, we haven't proved out this trend yet, or, it's like maybe it's smaller than you're saying. Like you're saying it's this whole 7-county area that needs to go up, but maybe it's really actually this one zip code that's driving it, and we need to bear that out and stuff. And so it's a constant debate back and forth on this stuff. But insurance is not individually rated, and this is one of the key misconceptions. People go, "I'm a good driver." Why is my insurance so high? I'm a good driver. But it's like the car you drive, where you park your car, where you drive your car to, how many miles you drive and stuff. Those are the things that really drive your risk. Yeah, if you have claims, your risk profile goes up. But even without claims, if you drive a Chevy Corvette 20,000 miles a year, and you're commuting 7 days a week, and your commute is at night, and all these kinds of things, your risk goes up and up of just being involved in something, right? You're on the road all the time, you're driving at sundown, someone else is going to hit you. It's not going to be your fault necessarily, but the insurance company is going to have to handle that claim, right? There's going to be costs associated with it. So it doesn't matter how good a driver you are, it matters what the risk of you being involved in an incident is. And it's just not driven just by you and but I've never been in an accident. I see that all the time. And that's what I mean. It's like a lot of these things come down to why is my house insurance so expensive? My buddy got a similar house and his insurance was $1,000 less. And it's like, yeah, but your buddy doesn't live in Minnesota. He lives in, somewhere more central United States where they experience he's in Colorado. They have less severe thunderstorms, and he's in an area that has zero wildfire risk. And you're living out in, one of the exoburbs where you have wildfire risk, and we have severe thunderstorms here all the time and all that kind of stuff. So it's like, yeah, your house costs less to rebuild, but does it cost less to insure? Not really.
Gotcha. All the moving parts in the back end that people don't realize. Same thing with mortgages. I talked about that before. What goes into your interest rate? There's 31 factors that go into what type of interest rate you can get. Because again, interest rate is risk-based. What's the risk of you defaulting on this loan? They're going to look at credit score. They're going to look at debt to income ratio. It's going to look at all this stuff that they keep stats on, right? And it's like, okay, if you fit these categories with this amount of down payment, that credit score, with that debt to income ratio, with that amount of reserves, your chance of default are higher than the person over here that might have a similar profile, but they're a little bit less in their debt to income ratio. They have more reserves to fall back on. And so that's why you get different interest rates for people that almost look to be the same borrower.
It's funny you bring that up. Rate tables for insurance in most states are something that you can get from the state regulator. You can say, hey, what ratings factors are you allowing this company to use? Because they have to approve, there are some things that you're just not allowed to rate on, and depending on state, that changes. Some states allow credit to be in it, some don't. Like how many years your driving record, all that stuff. But a lot of that stuff is you can just get the rate table. You can find out what impact each thing has. And yeah, insurance is the same way, where it's most carriers have 44 main rating factors or something like that in Minnesota. Yeah. It's a lot. And then there's secondary rating factors where some things will be split up because of this is special because it's in a floodplain. It's in this class of flood area, so it has a whole different rating table underneath a section and that kind of thing. But you can get that stuff. You can find out, hey, how does Progressive actually calculate their rates? They won't give you the raw numbers on on an individual, but it will show you the impact of each category and stuff. So if you just Google rate tables insurance or car insurance for Minnesota or whatever like that, you can find older year ones that people have gotten and posted. It's not by any stretch secret. The stuff that's secret is how they figure out how heavily to rate certain things. The actuaries are doing the back end data to adjust what those things end up being, and how they got there is the proprietary information of the insurance industry mumbo jumbo. Yeah, it's pretty neat. It'll make you go cross-eyed.
As always, I mean, when we talk about it, if you have a question about whether it's insurance or financing, a home loan, or what the housing market is, reach out to your local expert, because they're going to know those details of what's going on specifically where you're at. You could be off by hundreds of dollars on your monthly budget if you just try to hop online and do a mortgage calculator. There's just, you got to get the specifics for what you're trying to achieve.
Yeah. Oh, definitely. And I know all three of us see that all the time, where someone goes on Zillow or Realtor.com or whatever, and it has the little estimates at the bottom of your estimated monthly payment, and it's like all of the numbers that go into that calculation are definitely wrong. Yeah. they're not necessarily like hugely wrong. Sometimes they're pretty close. But like, I know insurance, notoriously, it's like people go, yeah, but the calculator said I would only be paying $50 a month for insurance. And I'm like, yeah, okay. If you just want insurance that only covers if the house burns down and literally nothing else, sure. But the calculation is just like an aggregate across like the whole country. They're not paying attention to that stuff. And I know that insurance is not dissimilar from like, oh yeah, your estimated monthly payment for your mortgage. It's like, okay, but does it really know your credit score? Does it know that there's going to be a rate buy down on this? So, like any of that kind of stuff? Of course not. Right. It just goes, sure, you're putting 5% down. This is what you're going to pay. Easy. Got it.
Yeah, like PMI is the biggest one, because if you look at interest rates, mortgage interest rates, you take a 660 score versus a 760 score, your interest rate difference might only be 0.5%, maybe 0.75%, right? Not the end of the world, not too crazy. But right. your PMI change might be $400 a month difference.
Huge. Yeah.
On something like that. That's where the real kicker comes in, right? Of course, there's no one-stop shop. I can plug in my stuff online and figure out what that's going to be. You can't do that as a consumer. So all the estimate and the Zillow stuff, everything that tries to just smash everything to the middle and just say, look, if we take everyone from the top to the bottom and we just roll them in a tight ball, here's the middle, and that's what we're going to put out there. That's going to be your cost, to go off of, which, as you guys know, can be way off from what reality.
Right. It can be way off. It can be close, but the only way that you're going to know an answer to that is by calling one of us and just being like, hey, this is what I'm thinking I want to buy. This is the area I want to buy in, and that kind of stuff. And we can steer you in the right direction and walk you through it and be like, hey, so the numbers that you're working with, maybe you should be thinking of buying something a little smaller. Or sometimes it's, hey, you can afford to buy way bigger than that. Like this calculation is not taking into account that you're going to put this much down and do these things and so on.
Right.
Talk to a professional.
I did I did an $800,000 loan for a guy, and his PMI was $89 a month. He was like,
that sounds pretty nice.
I was like, he was expecting it to be like 300. He was like, okay, well, that's kind of a game changer now. Like that's
that's like a whole car payment. I have a car payment now that is free. Sweet, cool, thank you.
Right. So now he could actually go up $100,000. He could actually bump up $100,000 in loan amount and keep his payment where he thought it was going to be.
Yeah.
What's another $100,000 do for a house?
Oh my!
Potentially a lot.
It's a completely different class, whether you're looking to add more square footage or you're looking to upgrade at virtually on every finishing material that was used throughout the house. I mean, you can do one of the two and get a completely different type of house.
Yeah, going from 425 to 525 is like a whole world change. It's like going from a Honda Accord to a BMW.
Right.
And that kind of brings full circle where when we had these buyers who they had in a sense was flipped on them, in that rate going up 1%, in the last week, they were looking at it and they said, gosh, shoot, we went from the 520, now we're down to the 460, and we weren't looking at anything less than 500 when our realtor was taking us showing us houses. So we did a quick search online, and the 460s looked like we were either gonna have to give up 100 square feet or maybe give up a bedroom or give up the granite countertops, whatever it might be. So they get a little discouraged in that snapshot of time. But again, the big picture is what these rates are going to do, especially if we can if our politics can square away some of the things that we're talking about, like debt ceiling, and help get those rates back down.
Yep, all good stuff here. Well, fellas, thanks for joining me this week, as you guys do every week. And as we come to the end of our show, we want to thank everyone for tuning in live and catching us on the podcast at a later time. You can find us anywhere that you find your podcasts and on our website, ushometalk.com. We are here to help with all of your real estate and financing needs here in Minnesota, South Dakota, and really the entire United States. I've been your host, Mike Overson with Luminate Home Loans, Marcus Walgrave, Hague Realtors, and Evan Little with Paragon Companies. We'd like to thank you for listening. We'll see you next week.